Hello, my name is John Gullo, Chief Investment Officer of Sanderson Wealth Management, and today I'll be walking you through unprecedented geopolitics and economics. While there are many loose bricks in this wall of worry, today we're going to focus on a few main themes: economic interactions between countries and how they choose to resolve them, the current state of interest rates and what an inverted yield curve means, as well as the role central banks have played in the current expansion and some risks to their independence and effectiveness. At the heart of recent strained economic interactions is protectionism. Specifically, we mean the policy of protecting domestic industries against foreign competition by means of tariffs, subsidies, import quotas, or other restrictions placed on imported goods or services. We see this in President Trump's America First policy, but that's not the only place. The Made in China 2025 policy and the Chinese economy as a whole contain numerous protectionist policies. In addition, the issue is present in the debate surrounding Brexit and how the UK will coexist with the European Union after the divorce. While protectionist policies may sound good to the masses, there's a lot at stake to the economy when trying to implement these types of policies. Across the globe, economies have expanded over the past several decades thanks to global trade. In fact, last year alone, $25 trillion of goods and services crossed international borders. Clearly, a significant amount of commerce is at stake here. But globalization has not benefited everyone equally, and a large problem for the United States has been huge annual trade imbalances. Now, the bulk of this imbalance can be narrowed down to four trading partners. The biggest culprit, China. China alone accounts for $420 billion of trade deficit, while Germany, Mexico, and Japan contribute an additional $81, $68, and $67 billion each, respectively. While economic relations with Germany, Mexico, and Japan are all important, today we will focus on our issues with China. Beyond the trade deficit, there are three significant wrongs that need to be addressed. First, China is a huge thief when it comes to intellectual property. We're talking about pirated movies, counterfeit designer goods, unlicensed software, as well as the theft of software code itself, just to name a few. Second, with forced technology transfers, the Chinese government requires foreign businesses to share their technology in exchange for market access. And third, multinational companies in most high-value industries are required to create a joint venture with a local company in order to build factories or offices in China, essentially giving away half of the business. So how is the Trump administration handling the Chinese trading issues? With tariffs, of course. As a refresher, a tariff, which is also called a customs duty, is a tax levied upon goods and services as they cross national borders. This process, however, is not one-sided. As we implement tariffs, so does China, back and forth in a tit-for-tat type fashion. In essence, these tariffs are now acting like anchors, slowing down both economies. Unfortunately, beyond the tariffs, both sides are also tarnishing foreign corporate brands in the media. Should this go on for an extended period, demand for U.S. brands in China could be permanently diminished. Right now you're probably wondering, is it working? Well, not exactly. To date, tariffs are having little impact on the U.S. trade deficit. Both imports coming into the U.S. and exports leaving the U.S. are little changed at this point. Where we do see an effect is in business sentiment and capital expenditures. With so much uncertainty surrounding where supply chains can be sourced and what demand may look like from overseas customers, businesses are sitting on their wallets. And they will likely continue to do so until they have better clarity on how this whole thing will pan out. Another area affected is currency. Over time, the US dollar has had periods of both strength and weakness when compared to our trading partners. The most recent period of strength started in January of 2018. right around the time that President Trump ordered a Section 301 probe into Chinese intellectual property theft. Tariffs started shortly afterward, and the currency has been appreciating since. Now, it's debatable whether the strength is market-driven reaction or manipulation by foreign governments. But either way, the dollar is much stronger today than in early 2018. And as a reminder, a strong dollar is good for us as consumers, but not so good as investors when we hold foreign securities. It is likely, however, that this process will reverse at some point in the future and revert back to historic averages. At that point in time, it will be painful for us when we're consumers, but profitable for us for the foreign securities that we hold in our portfolio. With no end to the U.S.-China trade tensions in sight, as investors, we should probably expect more volatility going forward. As the president expands his trade offensive via Twitter, the financial markets respond to the increased uncertainty with large price swings. In fact, if we look at the number of days domestic stocks have either risen by 1% or fallen by 1%, we can clearly see an increase in volatility from 9 days in 2017 to 64 days in 2018. While we still have many months to go in 2019, we have already experienced 32 days with big price movements, and potentially many more to follow. And where else do we see volatility and strained negotiations? The UK, of course. The June 2016 vote to leave the European Union caught many by surprise, and the soap opera did not end there. Negotiations proved to be quite difficult early on, and former Prime Minister Theresa May was unable to get her deal through Parliament on multiple occasions. This led to her resignation and Boris Johnson taking over power. It seems, however, that Boris is also having a difficult time navigating the divorce. In the past 2 weeks alone, he has had numerous setbacks. He lost several votes, expelled 21 individuals from his political party, and lost the working majority in Parliament. He failed to secure new elections, a plan he had hoped would bring in like-minded MPs. He was, however, successful in securing a temporary shutdown of Parliament through early October. This leaves only a few short weeks to resolve Brexit before the Halloween deadline. And in case you were wondering if he planned to delay Brexit, the answer is a resounding no. In fact, he would rather be dead in a ditch than ask for a delay. I would expect more volatility later in the year as this saga continues to unfold. Moving on to interest rates, there's currently a lot of concern about the yield curve. As a reminder, a yield curve is nothing more than a line that plots the interest rates, or yields, of bonds with different maturities at a given point in time. Plotted here, we have a yield curve from the third quarter of 2016. It is what we call a normal curve. As the holding period increases from 3 months all the way to 30 years, so does the interest rate. In this case, an investor is rewarded for tying up their money for larger periods of time. Today, that is not the case. Our yield curve is inverted. Short-term interest rates, such as the yield on a 3-month Treasury bill, highlighted here in yellow, are higher than longer-term interest rates, highlighted here in blue. But why do investors care so much? Why has it been in the news? Well, historically, an inverted yield curve has been a predictor of recessions. Specifically, the interest rate on U.S. longer-term government debt, such as a 10-year bond, has been less than the interest rate on shorter-term U.S. government debt, such as a 3-month T-bill, in every recession over the past 50 years. We have experienced 3 such recessions, highlighted here in gray, over the past few decades. If we plot the premium an investor receives for holding longer-term U.S. government debt versus shorter-term government debt, we can see that the premium was negative on 3 occurrences, all preceding a recession. The fact that this is occurring again right now is causing concern for many investors. While the yield curve is inverted in the US, we also have distorted bond yields across the globe. If we look at 10-year borrowing costs from foreign governments around the world, they're very low. In fact, many nations have negative interest rates on 10-year government bonds. While this has been going on for a few years now, it's increased significantly this year. In fact, as I record this today, there are over $17 trillion of negative yielding bonds globally. The US, however, is not attending this party at the moment. Our yield on a 10-year government bond is roughly 1.6%. So what's causing it? Unprecedented monetary policy. Let's take a look at our friend here, Mr. Kuroda. He and his colleagues from the Bank of Japan, they have set the overnight rate at negative 0.1%. And they have a target of 0% interest for 10-year Japanese government bonds. And that's not all. They've been busy, month after month, year after year, buying assets, to the point where their balance sheet now stands at $5.35 trillion US dollars. And they're not done. They continue purchasing with annual targets of 748 billion Japanese government bonds, an additional 56 billion of Japanese stock exchange traded funds, and just shy of $1 billion in Japanese real estate investment trusts. And they're not alone here. Mario Draghi and the European Central Bank are also participating. In fact, they increased stimulus just this past Thursday. In Euroland, the overnight bank deposit rate now stands at negative 0.5%. That means if you're a bank in Europe and you have excess deposits, you get charged a fee for holding them at the European Central Bank. On the bright side, banks can borrow at roughly 0% interest, and it can be even lower. If they qualify for a targeted long-term refinancing operation, the interest rate can be as low as negative 0.5% for up to 3 years. That means they borrow money and pay back less 3 years later. Now, their balance sheet stands at $5.2 trillion, but they haven't been expanding it this year. They stopped purchases effective January 2019. But just this past Thursday, they said they're going to start it up again effective November 2019. 20 billion euro a month, which equates to roughly 22 billion US dollars, with no end in sight. In comparison, at roughly 2%, the US Federal Reserve has set our short-term interest rate at a much higher level than others. The question is, should they be lowering it? Well, if we look at their mandate of maximum employment, stable prices, and moderate long-term interest rates, I'm not so sure. First, the unemployment rate is at 3.7% right now. That's the lowest it's been since the late 1960s. Also, wages are up 3.5% from a year ago. Both great signs for those in the labor market. Second, inflation has been hovering in the 1.5% to 2% range all year. Not too high and not too low. And third, we mentioned earlier that the 10-year U.S. Treasury is roughly 1.6 to 1.7% today. Compared to historic levels, that's extremely low. This puts Chairman Powell in quite a predicament. Let's recap. Unemployment, 3.7%. Wages, up 3.5%. Consumer prices, right in that sweet spot at 1.7%. And interest rates remain low. I think the Fed is in a good place right now. They have the ability to add stimulus, but they don't necessarily need to. But that's not to say they're not under a tremendous amount of pressure. Much of that pressure coming from our own president. In fact, President Trump has mentioned Mr. Powell or the Federal Reserve roughly 100 times year to date already. Recently, he asked, who is a bigger enemy, Fed Chairman Powell or Chinese President Xi? He called the Federal Reserve a bunch of boneheads just a few days ago. Pressure, 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 building and really questioning the independence of the Federal Reserve. And it's not just coming from the president. The financial markets are exuding pressure. They've priced in a 99% chance of at least a 0.25% rate cut and an 80% chance of a 0.5% rate cut before the end of the year. Pressure, pressure, pressure building. So what's next for monetary policy? Well, the Federal Reserve has several arrows in their quiver if needed. They can lower short-term interest rates, bringing them in the 1.5% to 2% range this year, in line with expectations. They could lower them further in 2020, should the trade war continue. They could bring short-term interest rates all the way back to zero if necessary. They could buy additional bonds, additional quantitative easing, if we should happen to hit a rough patch or a nasty recession. But that's not the case for the Bank of Japan and the European Central Bank. They're in a tougher position. Short-term interest rates are already zero or negative there, and their economies are not as strong as ours. Adding additional monetary stimulus would be very difficult. For them to get this perfect would be akin to having only one arrow that needs to be shot while performing a headstand during a thunderstorm and through heavy fog. Needless to say, I do not have a lot of confidence that additional monetary policy in Europe or Japan will come without potential negative effects down the road. In fact, we can already see the problem with European banks today after having negative interest rates in their home economies. So where does that leave us? As we look to the future, it's extremely important to remain long-term focused and be mindful that the U.S. is only one country among many. While we may be the big kid on the block, our economy is responsible for less than 27% of total goods and services produced globally. In addition, our stock market is a bit expensive today when compared to foreign counterparts. It's also expensive when we compare it to historic levels. As such, considering foreign investments may be a good idea today. And we believe that active management, especially given the current environment with monetary policy, can add value when we're looking at foreign securities. When investing within the U.S., we want to make sure we're not relying solely on the S&P 500. After all, the top 20 names account for nearly 1/3 of the index performance, with the bottom 200 names contributing less than 10%. When it comes to bonds, be mindful of the risks. We like to think of core bonds as the safe and secure part of your portfolio. Treat them as such. Don't overreach for added yield at the risk of safety. As the old saying goes, it's foolish to reach down and pick up pennies in front of a steamroller. After all, with numerous countries across the globe with debt levels in excess of 100% of their annual economic activity, now is not the time to lend them money for very long durations of time. Especially when research has shown that debt in excess of 90% negatively affects economic growth going forward. Third, avoid bond index funds. In most indices, countries, companies, and sectors with the highest debt levels will have the greatest representation in the indices. There is no economic foundation for holding more of a company's or country's debt as it borrows more. For the non-traditional category, first, avoid pure junk bond funds in favor of a more diversified option. Currently, investors only receive an additional 2.3% interest for holding below investment grade bonds, when on average they received 3.7% historically. Second, reevaluate your alternative strategy funds. Are you looking for risk reduction, return enhancement, or a combination of the two? Within this category, as the expected return increases, the ability to dampen volatility tends to decrease. Invest accordingly. Third, take some profits in U.S. real estate and infrastructure. Commercial real estate values are now at their all-time highs, 27% greater than the prior peak and 99% higher than the lows experienced during the prior recession. Do not assume that what drove prices higher over the past decade will continue in the next decade. As such, trimming both categories back to their target weights would not be a bad idea in the current environment. As we close out the presentation today, I want to remind everyone that over the past decade, we have relied heavily on central banks to solve all sorts of problems. With ever-increasing amounts of stimulus, the monetary rescue vehicle has managed to safely navigate the rocky environment to date. As additional challenges arise, it's uncertain if pushing monetary policy further into the theoretical realm will result in a safe journey for economies and financial markets. As such, as investors, we need to think strategically, allocate capital wisely, and not rely on central banks to push risky assets higher, nor expect interest rates to remain impractically low for both good and bad creditors indefinitely. Thank you for watching this presentation today, and if you have any questions or comments, please feel free to give us a call. Have a great day.